Hi, and welcome to CUNA's Economic Update. I'm Jordan Van Ryn, Senior Economist at CUNA. In this update, I'll be sharing some updates to our forecast from our last meeting on June 8th with CUNA economists as well as economists from CUNA Mutual. And I'll also be covering some of our updates to our monthly credit union estimates, which include data through April, which provides some insights as to how the coronavirus pandemic is affecting credit unions. Let's go ahead and get started. Here you see U.S. economic growth, or the percentage change in total gross domestic product, everything produced and supplied in the U.S. economy over a year. And you can see that it has already dropped precipitously. There was a 5% annualized decline in the first quarter of this year. In fact, the National Bureau of Economic Research has already stated that we are officially in a recession. As far as I can recall, this is the fastest that they have ever declared a recession in U.S. history. They often take months or years after the recession to determine, but it was so clear that this time around that we are in fact in a recession. We expect in the second quarter, with all of the stay-at-home orders and economic activity really retreated, with people staying home, not traveling, not going out to restaurants, of course not going out and shopping, that there's going to be a pretty dramatic decline in economic growth in the second quarter of around 30% annualized. However, we do see economic activity already starting to pick up. Some of the stay-at-home orders are being lifted. It's hard to say exactly what that's going to do to the spread of the virus at this point and the health ramifications, but at least in terms of the economy, there are some gradual signs of economic recovery, which we expect to continue into the third and fourth quarters. So overall, we do expect a pretty significant decline in annual economic growth of about 3% this year before a somewhat modest recovery of 2.5% next year. Now, I should say that our forecast, of course, includes a lot of uncertainty. It's very difficult for epidemiologists as well as economists to predict what's going to happen with the virus or the economy. So we have a number of assumptions for our forecast, but we must emphasize that there's a great deal of uncertainty. One of the main assumptions is that the virus will continue to recede as we go throughout the year. Dr. Fauci and other experts do predict that the virus will come back to some degree in the fall and winter months, so we do include that in our forecast. However, we do expect expanded testing and other preventative measures to lessen the degree of the impact of that rebound later. So we don't expect it to be quite as bad as the second quarter. We also do not expect a vaccine anytime soon, probably not until well into 2021. And then finally, we expect continued very aggressive fiscal and monetary action. We know the Federal Reserve has already lowered interest rates and is going to continue to keep interest rates very low, both short and long-term rates. And of course, we know that it's also expanded many different lending facilities and gone well above and beyond efforts, even in previous recessions, to buttress the economy. So it will continue to do that. We do expect Congress to also pass another stimulus package, probably in July, before some of the provisions of the CARES Act expire. It's hard to know exactly what will be in that, but we do expect some continued support for businesses and households, and probably some funding for states as well. So that's kind of our assumption for this forecast, but like I said, there are a lot of things that could change. Congress might not fully step up to the plate and might not provide as much stimulus as we expect. There could be a much greater return of the virus in the fall or winter months. So to the extent that there are risks, they're mostly to the downside. So to that extent, this is perhaps a somewhat optimistic forecast, but also probably the most likely forecast as well. So let's look at the unemployment rate. We had back in May a jobs report that showed that the unemployment rate rose to an incredible 14.7%. This is the highest unemployment rate on record since the Great Depression. It's basically wiped out all of the U.S. net job gains since 2011. So this 10-year record recovery has basically been wiped out. But the big question is, of course, how many of these job losses are permanent? Most economists, ourselves included, were somewhat surprised that the unemployment rate actually fell last month. So the May unemployment rate reported by the Bureau of Labor Statistics fell from 14.7% to 13.3%. A couple of points about that. One of the main reasons I think economists got it so wrong is that economists were very focused on the weekly unemployment insurance claims data, which was showing basically millions and millions of people applying for unemployment insurance. And that data was being updated weekly. However, economists didn't have good data on people re-entering the workforce. So it seems like one major factor is that just more people re-entered the workforce than economists predicted. So that helped bring the unemployment rate down. Another major factor appears to be the government assistance, particularly the Payment Protection Program, which is supporting small businesses and incentivizing them to either maintain or rehire their employees. So that seems to have had a really major effect as well at keeping the unemployment rate down. However, a lot of those provisions and the PPP program ends at the end of June or July, so it's hard to know what would happen if that expired and Congress didn't act further. We expect this unemployment rate to continue to fall, but stay relatively high through the end of this year and next year, reaching about 10% this year and 8% by the end of next year. However, it is important to point out, and the BLS mentioned this in its report, that the Bureau of Labor Statistics, the unemployment jobs report, is really based on a survey of households. I believe it's about 60,000 households that they survey to ask, who has work, who's looking for work, who's temporarily unemployed. And there's a lot of statistical noise with everything happening right now. And one of the major adjustments that the BLS had to do was account for a disproportionate number of workers that were recorded as employed but absent from work due to other reasons. It seems that most of these people, millions of people, were affected by the coronavirus and lost their jobs because of the coronavirus, but were listed as unemployed due to other reasons. So if we include these people back in the unemployment rate, then we see that in fact the April unemployment rate was as high as almost 20%, really an incredibly high unemployment rate. And it did still fall in this adjusted unemployment rate, but only to about 16.3%, so quite a bit higher than the 13.3% we see in the official statistics. For now, we're going to include both the adjusted and unadjusted unemployment rates in our forecast, and we expect those to kind of merge closer and closer together as time goes on. For some historical perspective, as I mentioned, whatever unemployment rate you use, adjusted or unadjusted, this is incredibly high unemployment with millions of people losing their jobs, the highest unemployment rate by far since the Great Depression, and as far as our official data goes back to 1948. So we see here unemployment, in the range of maybe 15 to 20%, and then coming down a little bit to 13 to 16%. So at its peak, back in April, the unemployment rate was, about 50 to 100% higher than the peak of the Great Recession. So that really shows just the magnitude of the job losses in the economy. This graph I found really interesting, really neat graph from the Washington Post the other day that basically shows the number of months it's taken to recover from all of the post-World War II recessions. And you can see in those gray lines that the average recession has taken, anywhere from 2 to 3 years to recover all of the job losses that were lost in those recessions. You can see the blue line represents the Great Recession, and that recovery took a historically very long period of time. You can see 70 months, around 6 years to recover all of the jobs that were lost during the recession. And then in the red line, you can see where we are now. Job losses were much worse than any of these prior recessions. You do see a bit of a recovery, but it puts it into some perspective that this recovery is still very small at this point. There is a lot of discussion whether it's going to be a relatively quick V-shaped recovery or a much longer kind of recovery, or perhaps even some kind of W double dip recovery, and that's very hard to estimate at this point. But just to give you some perspective, this recovery probably won't take as long as a Great Recession, but if history is any kind of indicator, it's still likely to take at least several years to recover all of the jobs lost. It really, of course, depends on how many of the current job losses are permanent, and that's a big question that we don't know the answer to at this point. I've seen some pretty good estimates from some pretty good economists that estimate that maybe about 40% of the jobs lost during this recession are permanent, in which case that would mean that unemployment would still be relatively high even after the stay-at-home orders are ended and the economy begins to recover. And I think that does make some sense. You can imagine that as the economy recovers, there are going to be some jobs that come back relatively quick. However, it's hard to imagine that people are all of a sudden going to start hopping on airplanes or traveling or going to restaurants in large numbers. And different parts of the country might be hit in different ways as well by the virus. In fact, you already see some states where the virus continues to increase. So this will likely take some time. It may be quicker than other recessions, but certainly unlikely to recover very quickly, at least within the next year or two. We also know that, unfortunately, as in prior recessions, people of different backgrounds, different races and ethnicities are harmed disproportionately more than others. In particular, you can see that the African American and Latino Hispanic unemployment rates were already much higher than the white and Asian unemployment rates, and have risen much more than the white and Asian unemployment rates during this crisis. In fact, you can see that the Hispanic Latinx unemployment rate has risen much more than any other. And that could be because of the composition of workers that are immediately affected from this recession. For example, there are much higher proportions of Hispanic workers in fields like restaurants or states that are located in tourist areas. The Hispanic unemployment rate has come down a little bit, and you see also the white unemployment rate has come down a bit in May. But unfortunately, you actually see increases in the African American unemployment rate and also the Asian unemployment rate in this last jobs report. Unfortunately, we know that women have also been disproportionately affected by the current crisis. You can see that the unemployment rate for women jumped much higher than for men and remains higher than for men. This is actually in contrast to previous crises, for example, the Great Recession, when men were hit much worse by that crisis, particularly because during that crisis, it first hit industries that include a disproportionate number of men, such as finance and banking and construction. In this case, the sectors that have been first hit include a disproportionately higher number of women, such as educational and health services and leisure and hospitality. In fact, this is the biggest female-male gender gap in unemployment in history. Okay, let's switch to the credit union side now, and this is loan growth by loan product. So I'm going to show you first what was happening last year and the prior few years in terms of annual loan growth at credit unions. So this is before the coronavirus even started. And you can see that several loan categories were sort of staying pretty stable. This is credit cards and other unsecured loans. But we did see some dramatic falls in loan growth in certain categories such as auto loans. So you saw new auto loans were already falling and grew only 0.1% last year. Used auto loans also fell quite a bit and grew only 4.1% last year, much lower than any prior year. First mortgages stayed pretty steady and had strong growth of 9.4% last year. HELOCs and second mortgages fell a little bit, but kind of online with the average over the past 6 years. And commercial loans actually picked up a little bit last year, growing 4.7%. Now, so far this year, we don't have any data from the NCUA to be able to look at the first quarter. However, we do have CUNA survey data from the monthly credit union estimates as of April. So what I'm going to show you now is data including CUNA survey data that is year to date through April, so we can get a sense as to what's happened to these different loan categories so far this year, including that full month of April that included some of the events and stay-at-home orders from the coronavirus pandemic. So here's what we see. Credit cards down 8% so far this year. Other unsecured loans down 3%. New auto loans down about 2%. Used auto loans about flat, up a little bit, 0.4%. First mortgages are a bit of a bright spot, actually up 7.2%. Still down, but not quite as much as some of the other loan categories. And we see that credit unions are continuing to find ways to do mortgages, particularly in this environment of extremely low interest rates. A lot of people are asking for mortgages. We see a lot of refinances as well, and a lot of people coming over from banks as well to refinance and get mortgages with credit unions. HELOCs and second mortgages are down negative 2.1%, and commercial loans also way down negative 8%. So pretty much across the board, declines in loan growth, except in kind of first mortgages. So where does that leave us for our forecast? Overall, the monthly credit union estimates show that credit union loan growth is up about 1% this year through the first 4 months. But as the economy begins to kind of reopen and people go out and spend more, and hopefully consumer confidence picks up a little bit, we do expect credit union loan growth to continue to pick up, partly bolstered by the relatively strong mortgage growth. Of course, mortgages, as we know, make up about half of credit union loan portfolios. Auto loans make up about a third of credit union loan portfolios. So we estimate credit union loan growth at about 3.5% this year, still well down from prior years, and about half of the long-term annual credit union loan growth rate, but much better than what we experienced during the Great Recession. We do expect it to pick up a little bit next year to about 5% growth. We expect a pretty similar trend for credit union membership growth, falling to about 1.5% this year before a bit of an uptick to 2% next year. Credit union savings growth has increased dramatically already this year. We can see this in the credit union monthly estimates, where as of April, credit union deposit growth has already gone up over 9%. That's more than all of last year. Now, this is due to a number of factors, including the fiscal stimulus checks that came in around March and April and continue to come in, as well as, of course, tax refunds also come in around this time. So we do typically see fast savings growth towards the first and second quarters of the year, but this was even more than usual. Now, typically, you can see even in the prior recessions in 2009 and 2001, credit union savings growth does tend to increase. This is due to cautionary savings. People just end up being more anxious about the future and want to hold on to their money and spend less and borrow less. So we expect that credit union savings growth is going to increase dramatically this year to maybe around 14% or so before coming back to a relatively normal level next year. Now, so far, according to the monthly credit union estimates, we haven't seen any significant deterioration in credit union portfolio quality. There was a slight uptick in delinquency rates, but really nothing significant. Of course, we know that most credit unions are doing all sorts of things like loan modifications and deferments and other means to really help credit union members weather this storm without having their loans go delinquent or into charge-offs. Of course, it's unclear what will happen if this continues for a significant amount of time and there isn't more support from Congress. We could see a bit of an increase in delinquencies and charge-offs, and that is what is expected. Historically, as the unemployment rate increases, we do see pretty significant increases in credit union delinquencies and charge-offs, as you can see here during the Great Recession. But we don't expect delinquencies and charge-offs to rise to those levels for a number of reasons. First, as mentioned, many credit unions are allowing skip pays, debt restructuring, forbearance, and other means to allow for repayment flexibility, which really is going to help members get through this without having it hit their credit reports. We've also seen extremely aggressive fiscal and monetary policy, particularly the direct payments to households and expanded unemployment benefits, as well as the PPP program, which are also helping households pay their bills for these couple of months at least. Also, mortgage markets are remaining relatively strong with low interest rates and so far no big declines in housing prices. So that should help people stay current on their mortgages, unlike during the past crisis when we also saw a big decline in housing values. And finally, although this recession is very deep and the unemployment rate has risen very dramatically, there are signs that it could also recover relatively quickly. We don't expect a very fast recovery, like a V-shaped recovery, but we do expect a recovery that could be significantly quicker than the Great Recession. So that should also help people, come back to their jobs a little bit quicker and hopefully be able to pay their bills. And here is our complete credit union forecast, which you can find on our website at cuna.org/economics. I wasn't able to cover everything here, but you can see things like the loan to share ratio, which is expected to fall pretty dramatically with the fast deposits growth and slow loan growth. We do also expect earnings to fall off pretty precipitously, as well as a falling net worth ratio. And that's really due to, of course, higher loan loss provisions, fewer loans, a little bit higher loan losses, and very tight interest rate margins. All right, that's it for this update. You can find more information, of course, at our website at cuna.org/economics. If you have any questions, feel free to email me directly at jvanryan@cuna.coop. You can also email our team for any statistics or updates at qstat@cuna.coop. And you can follow me on Twitter at Jordan_Van Thanks for tuning in to the CUNA Economic Update. I hope you all stay safe and healthy and look forward to seeing you in future economic updates.